If you're a homeowner considering refinancing your mortgage, do me a favor and stop until you finish watching this video, as we're going to discuss when it makes sense to refinance and when it doesn't make sense to refinance. And I'll be completely honest, for the majority of you out there watching this video, it's not going to make sense to refinance your mortgage. At the moment, mortgage rates just reached 23-year highs and are currently sitting in a place where interest rates might continue to rise even further. But here's the good news. Nearly 90% of homeowners out there in the market have an interest rate below 5%, with nearly 70% of those homeowners having an interest rate below 4%, which means if you're a current homeowner at the moment, you're in a really good position versus those out there that are looking to buy a home. Because not only are home prices continuing to rise, we're still seeing volatility in the interest rate market, which is exactly why we're seeing housing affordability sit at all-time lows. But with homeowner equity sitting at nearly $30 trillion, there's a large majority of homeowners out there looking to take advantage of this and refinance, either by doing a cash out refinance so that they can pull cash out of their property and pay off debt, or on the flip side, some people are looking to pull cash out of their home so that they can buy another property. And on top of that, one of the other things that I'm hearing a lot of in this market is people tired of their mortgage insurance. They hate that they have mortgage insurance on their property, and therefore they want to refinance and get rid of it. You'd actually be surprised with how many messages I get in a given week with somebody that has an FHA loan that purchased back in 2020 or 2021, and they're frustrated with the idea that they have mortgage insurance and that they're not in a position to refinance. So in today's video, we're going to dive into this in a little bit more detail. We're going to talk about when it actually makes sense to refinance and when it doesn't. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything real estate related. So going back to what I said a moment ago, there's a large percentage of homeowners out there at the moment that have mortgage insurance on their loan. Now, mortgage insurance typically comes when you put less than 20% down and you buy a home. So if you're buying a home and you only put 10% down, chances are you're going to have mortgage insurance on your loan. And mortgage insurance is one of those things that stays on your loan until you get at least 20% equity in the property, in which case you need to call your lender and have that mortgage insurance removed. So if you currently have 20% equity in your property, you don't need to refinance in order to remove that mortgage insurance. It's just a simple phone call to your current lender to let them know that you think you have 20% equity in the property and you'd like that mortgage insurance removed. Now, in which case you don't do that and you get 22% equity in your property, so your loan to value is 78%, then the mortgage insurance should fall off that loan automatically. But here's the catch. If you have an FHA loan and you only put 3.5% down when you bought that property, you're going to have mortgage insurance on that loan for the life of that loan, regardless of how much equity you get in that property. And at the moment, there's a lot of people out there that bought using an FHA loan back in 2020, 2021, even parts of 2022. And they're frustrated with the idea that they have this mortgage insurance. Please understand, for anybody out there that has mortgage insurance is not a bad thing, because in many cases you wouldn't have been able to purchase a home otherwise. Mortgage insurance is basically the cost of doing business. But with that said, what I want you to do is consider your effective interest rate when we're talking about mortgage insurance. What is the effective rate? Well, the effective rate is your interest rate plus your mortgage insurance on top of it. And that's one of the calculations you're going to do to see if it actually makes sense for you to refinance and try to get rid of that mortgage insurance. So in today's example, let's just say that you bought back in 2020, 2021, and you were able to get a 3% interest rate using an FHA loan. Well, back then, mortgage insurance on FHA loans was 0.85%. So what you would do is take your 3% mortgage rate and you would add the 0.85% mortgage insurance to it, which means that you would have an effective interest rate of 3.85%. And let's compare that to where interest rates are today on an FHA loan. Interest rates today are sitting somewhere around 7%, which means that your interest rate is nearly half of what interest rates are at today, which means there's no world in which you should consider refinancing your mortgage. Now, I realize it might be frustrating to have to pay that mortgage insurance every single month, but understand there's a lot of people out there that would give their arms, their legs, legs even, in order to have an interest rate anywhere close to that today. So my recommendation for you, if you're in this position, is just to keep paying your mortgage and don't actually worry about the mortgage insurance, because at the end of the day, it doesn't really matter. If I'm being honest with you, there's a really good chance that you're not going to see interest rates anywhere close to where it would make sense to refinance anytime soon. So if I were in your position and I had a loan that had a super low interest rate and I had mortgage insurance on it, I would just do what I've been doing over the last couple of years, and that's just continue to make my mortgage payment and live my life. But let's say that you don't have mortgage insurance, but you have some debt. Maybe you accumulated credit card debt over the past couple of years, or you have some car loans and you're looking to pay off all of those loans by refinancing and pulling cash out of your property. Well, in some cases, this actually may make sense, but for the majority of people out there, I would tell you to try to hold off until interest rates pull back to consider pulling cash out of your property. But let's say you're one of those people out there that has a super low interest rate on your first mortgage. Something you might want to do before pulling cash out of your property is check into a home equity line of credit. A home equity line of credit is essentially a credit card on your equity. This could allow you to keep your first mortgage, but pull out cash using this second mortgage, if you will, to pay off the debt that we talked about a moment ago. Now, in some cases, this makes sense. In other cases, it doesn't. Now, if you're in the position where you have a really low balance on your first mortgage and you're pulling out a lot of cash to pay off debt, then chances are it's going to make more sense to refinance it all into one new first mortgage. But let's say that you're on the other side and you have a large balance on your first mortgage at a very low interest rate and you're only looking to pull a small amount of cash out. That's when a home equity line of credit makes the most sense. But this is where you have to be careful with home equity lines of credit, because many of them are variable rates. They adjust based on the prime rate. So if the Fed continues to hike the Fed funds rate, then the payment on your home equity line is going to continue to go up. But here's the good news. If the Fed starts to reduce the Fed funds rate, then the payment on your home equity line is going to come down. So regardless of what you decide in this situation, just make sure you're working with a professional that explains this stuff to you and you're not just taking the numbers at face value and going along with whatever they say. Make sure you completely understand it so that you know exactly what you're getting into. Now, with that said, there's something I want you to pay attention to when you're considering refinancing your mortgage, and that is your break-even point. Now, what am I talking about when I'm talking about break-even point? I want you to figure out how much money it's costing you to refinance your mortgage. If you decide refinancing is right for you, you need the cash out for whatever reason, you have to do it. How much is that mortgage actually costing you? Now, I know some lenders out there will say, there's absolutely no cost involved. I'm paying all your fees, which is actually the best way to go about this. But in most cases, you're paying some sort of fees when you're refinancing your mortgage. So what I'd like you to do is figure out how much cost that is and compare it to how much you're actually saving per month. Let's say, for example, it's going to cost you about $5,000 to refinance your mortgage. And let's say that you're only saving $200 a month. That's a pretty substantial amount of savings, but when you divide it into the $5,000, that means that you need to have that current mortgage for 25 months. And the reason this is super important is because if you refinance that mortgage or sell that house before 25 months, then you've essentially lost money on this deal. So you want to make sure that your time horizon exceeds the amount of money that's costing you to do this refinance. And if you're someone who believes that interest rates are going to come down in the future, like myself, then you don't want to be in a position where you're paying cost to refinance now, because if interest rates come down again in the future, then you might also be paying cost at that time as well. So just make sure you understand your break-even point when you're considering refinancing. And while we're on the subject of refinancing, make sure you're shopping around, you're talking to a couple of different lenders and comparing things. I don't want you to get caught up in the mindset that, you have to go with the lender with the absolute lowest rate, because oftentimes that can end up biting you in the butt. But you do want to go with the lender that has a competitive rate and also knows what they're doing. If I'm being completely honest with you, if you're going with one of the major lenders out there, if your lender has a commercial on the TV, then there's a really good chance that you're getting overcharged for that loan. Because understand, these lenders have to pay for those commercials in some way. But at the same time, not all of those lenders are bad. If you're going with one of those lenders, just make sure you're getting a quote from, say, another lender, a broker, so that you have two things to compare to make sure you're not getting taken advantage of. And if you're somebody out there looking to shop around, you're currently in the market refinancing, and you want a referral to somebody I know, like, and trust, do me a favor and check the link below. These are people that I know, I've vetted, I have relationships with them. I'm not out here referring you to some random person on the internet. I'm making sure that you're getting taken care of. So if you're shopping around, just make sure you use that link for a trusted referral. So we've talked about the idea of not getting caught up in, the whole mortgage insurance idea. We've also talked about the idea of, if you're refinancing, you're pulling cash out, that you know your break-even point, in addition to not only looking at the interest rate, making sure that you're getting somebody that can actually follow through and provide you that rate. There's a lot of people out there on the internet that will tell you one thing and deliver another. Make sure whoever you're using is reputable and they have good reviews and they can actually deliver on what they promise. And the last thing I want to talk about in today's video is, if you're considering refinancing and you're in a position to go back in the same term of loan that you currently have, that is 100% my recommendation. Now, what I'm talking about here is, oftentimes people will refinance their mortgage. The lender on the other side will say, hey, I can save you X amount of dollars, but you're actually going from, say, a 25-year loan back into a 30-year loan. So part of the savings that you're getting is because your mortgage is restarting. So just make sure, if you've been in your mortgage for any period of time and you've paid it down, ask your lender to run numbers based on the same loan term that you currently have. That way, if you are refinancing, you're still on the same timeline to pay off your mortgage, versus resetting it every time you refinance. There's a large percentage of the population out there that every time interest rates drop, they refinance. But on the flip side, they always go back into a 30-year loan. So these are going to be the people come retirement that still have a mortgage, versus those that have been able to take advantage of lower rates, but also take advantage of keeping the term the same. And the last thing I would say about refinancing is, don't be one of those bottom fishers out there that keep waiting for interest rates to go lower and lower before you refinance. If you're currently in a position to refinance, you've had conversations with the lender, the numbers make sense, I would say just go forward with it. There's a chance that interest rates go higher. Now, there's a chance that interest rates also go lower, but for the better part of 6 months or so, there's been a large percentage of lenders out there saying, marry the property and date the rate. And what they meant by that was, find the right property and don't worry about the rate, because you're going to be able to refinance in the future. Well, here we are 6 months later, and interest rates have actually gone higher. So while there's a lot of us out there that believe interest rates are likely going to go lower, we don't know exactly when that's going to happen. So what you don't want to do is sit there and wait for interest rates to go lower and miss the right opportunity if the interest rate makes sense now. So like I said earlier, for the large majority of people watching this video, it's not going to make sense to refinance. But if you are one of those people considering it, just make sure you're working with trusted sources, somebody that's been in the business for an extended period of time, that understands the market, can answer your questions, and ultimately guide you through the process. Now, with that said, if you have additional questions about refinancing, really want the 101, if you will, when it comes to refinancing, do me a favor and check out this video here.